Hey, so in today's video, we will learn to buy options using volatility, wherein we will understand the characteristics of volatility and then we will understand how it actually behaves, and eventually we will try to buy options looking at the implied volatility chart. So let's first quickly understand few of the option buying strategies. So let me just take you to architect. So let's say options architect. And let's say I'm buying a call option. So the instrument is Canfin. So over here, if you see, there are two curves on the graph. One is a gray curve on the graph and the other one is the orange curve on the graph. The gray curve shows us the T plus N PNL. Now let's say if I want to see how will my PNL look like one day ahead from here, then I can just move the day slider by one day ahead and I can see on what various levels of Canfinom how much PNL I might expect. Now if I just want to hide the open interest, then I can do that. Alright, and if I just want to hide or unhide the standard deviation levels, again I can do that. So this is a simple call option which I have bought. So let's say if I am expecting that the implied volatility might go up by 10%, then what would be the impact of 10% up move in the implied volatility on this strategy? Now if you see, the payoff has slightly shifted on the upper side, wherein at the same level at 775, I was not making a decent return when the implied volatility skew was kept at 0. So if I'm expecting 10% jump in implied volatility, I'm making decent enough return. So now let's see what will happen if there is a 20% up move in the implied volatility. So let's say 20% up move and then just click enter. Now if you see again it has shifted. So at 775 first I was making roughly 2700. Now how much I'm making? I'm making roughly 4500. So now why is this happening? This is happening because of the jump in implied volatility. So what we conclude from this is that when the implied volatility in the market goes up, the option premiums also go up. Okay, so we will generally see in the high volatility environment, the options are relatively expensive, the premiums are relatively bigger. So it is because of the risk which is attached to those particular options. So this is for call options. So what is happening? Whenever the implied volatility is going up, so the call option premium is also going up. So regardless of the fact that all the things in the market remaining constant, okay. So I'm expecting here the market will remain where it is, the days to expiry remain where it is. There is no major change which will happen in days to expiry, neither the underlying price. I'm just expecting one simple thing, that the implied volatility will go up. So what we conclude, if I'm expecting up move in the implied volatility, I should buy options. So let's do the same thing with put option as well. All right. Now just focus on 765. If the implied volatility is 0, that means if I'm expecting no movement to happen in implied volatility at 765, I might end up making roughly 3000 rupees to 948 to be precise. Now, if I'm expecting 10% up move in the implied volatility, then let's see what happens. So now if you see on 765, first I was making 2950 roughly. Now I'm making 4800. So why is that happening? That is happening because of the jump in the implied volatility. So now, even for put options, if the implied volatility in the market goes up, the put options will also become expensive. They will become much more, bigger in premium. Now, let's say I am going ahead and creating a long straddle. So this is how long straddle will look. So let me just do it of the same strike price. Okay. Yeah, seven. So what I have done is I have bought 770 put option and I have bought 770 call option. Okay. Now, when I'm doing something like this, first thing is I have no forecast on the underlying. So neither I'm bullish on the market, neither I'm bearish on the market. But if I create a strategy which is, buying put option and call option both, so the problem would be theta. Okay. So let's say if I hold a strategy for 2 days, then I will end up making a theta loss over here, right? I'll just end up paying the time decay to the market. So now for this strategy to work, one thing should go in my favor, which is implied volatility should go up. So because of which the call option which I have bought, that will yield me returns, and also the put option which I have bought, that will also give me returns. So the idea is simple, that whenever I'm playing volatility, whenever I'm buying volatility, whenever I'm going long on volatility, My idea is to buy options. I am not forecasting where can fin home or where the underlying will go. Only forecast is that the implied volatility will go up, due to which the call option will go up and the put option will also go up. So in case there is 20% jump in implied volatility, then you can see I am making a decent enough of return on every level of can fin home. Best part, I will have no undefined losses in something like this. Next thing, can fin home going anywhere, I'm going to make decent returns. And if implied volatility goes in my favor, that means if it goes up, I'm going to make a decent chunk over here. Now, only problem is time decay. If there is no movement which happens in Canfino, and if the implied volatility also doesn't go up, then that is where the strategy starts creating little bit of problem. So for that, if I create something like this, my maximum holding period would be 2 to 3 days. Okay, if implied volatility and let's say if there is a big movement happening in the instrument, I will book that particular strategy. So now let's understand characteristics of implied volatility. So now we know that what we want to achieve from the market. So typically, if you see the implied volatility chart, you will see that it is mean reverting in nature. Okay, it would not trend. So you will never see implied volatility which is trending in the upwards direction, or you will never see a chart wherein implied volatility is trending in the downwards direction. Now, what my idea is, if there is a mean reversion characteristics in implied volatility, so what I'll do is whenever the implied volatility is at the bottom, okay, so let me just okay, so whenever it is at the bottom, I will prefer buying options. Okay, it doesn't matter if I'm buying call option or put option or I'm buying both, but if the implied volatility is at the bottom, then I'm expecting a jump to happen in implied volatility, due to which my call option premiums would become expensive and also my put option premiums would become expensive. Similarly, if let's say implied volatility hits bottom, okay, anywhere. So my idea is simple. I will prefer buying options. If I'm directional on the underlying, I'll prefer buying call option if I'm bullish, and buying put option if I'm bearish. But if it is at the bottom, my simple, or I would say my to go option is to buy options. So let's see the characteristics of implied volatility. So for that, I will navigate to IV chart in the application. Link would be there in the description box below. You can access IV chart from the search panel and just search for chart, and the IV chart analytic will pop out. Now let's say Nifty. Okay, and this characteristics will remain the same across all the instruments. It doesn't matter if it is stock options or be it index options. So now we are looking at the 250 days implied volatility of Nifty, wherein the orange line is showing us implied volatility and the green line is showing us the futures price. Now if you see, it is mean reverting in nature, right? The orange line, it is never trending, whereas on the other side, if you see, the green line, which is the futures price, it is trending to an extent. So you'll never see implied volatility chart which is continuously upwards or downwards. It will mean revert, it will come back to its normal regime. So my idea is simple. Whenever it is at the bottom zone, I will prefer buying options. Somewhere over here, right? I will prefer buying options, and whenever it is at the top, I will prefer selling options. But today we are going to understand about how can we buy volatility. So we will only focus wherever it is hitting the bottom and where we can go ahead and create a long volatility trade. So when I say long volatility, what will be our trades? Our trades would be buying options, long straddles, long strangles, where we are going ahead and purchasing options in net. Now coming to, how can we go ahead and identify these opportunities? So we have a simple analytic which is named as Vol Trader. So over here, it basically generates opportunity or identifies opportunities for us, wherein long volatility and short volatility trades would be identified. Wherever there is long volatility mentioned, it means that there is a potential probability of implied volatility of Tata Motors to go up, right? Similarly, on short volatility, it is indicating that there is a probability of implied volatility of LNTFH to go down. Now it's very easy. Whenever we see long volatility, the strategy is simple. We will prefer long volatility strategies, which we already have learned: straddles, strangles, where we are buying straddles, buying strangles, or we are buying options. So the idea is to benefit from volatility, the up move in the volatility. So looking at Quantsapp Vault Trader, we can easily identify which are the instruments where there is a possibility of long volatility trading opportunity, where is the possibility of buying options and getting benefit of the jump in implied volatility. So that was it from today's video. Do check out Quantsapp Vault Trader from the link in the description box below. See you all in the next video.